UTI Value Opportunity Fund is a value fund as per the SEBI classification. We manage the fund with a multi-cap bias and a value tilt. As a philosophy, we follow an intrinsic value approach as compared to the traditional multiple-driven valuation approaches. Intrinsic value is the sum total of the cash flow which a company can generate over a period of time. Decisions on market cap and sectoral preferences are based on valuation consideration, while stock selection is based on what we call a barbell approach, where on one hand we buy stocks which the market is underappreciating in terms of cyclicity as well as turnaround opportunities, and on the other hand we buy stocks which have long growth runway and strong franchises. In both cases, we buy something which is cheap relative to expectation. As far as portfolio construction is concerned, we avoid taking balance sheet risk, focus on sectors which have seen supply disruption or supply cuts, and on sectors where there is across the board pricing correction. We always keep overweight position in the stocks that we buy. All the stocks in our portfolio are overweight, which also signals our high conviction level. We have 53 stocks in the portfolio with an active share of around 65% as on July 2020. We have flexibility in terms of moving around market caps. Although predominantly we have a large cap bias, the small and mid cap exposure can vary depending on valuation consideration. As on July end 2020 end, small and mid cap exposure is around 29%, marginally down over the last few months. As far as sectoral allocation is concerned, we have overweight in the auto space, where we think the last 24 months have seen cyclical underperformance. Cash profile of most of the auto player is rich, valuation is reasonable, penetration levels are low. Over the last few months, we have added exposure to OEMs in the passenger vehicle, two-wheeler as well as tractor segment. Pharma is another sector where we have a large overweight. We have around 11% weight for and own around 6 pharma names. The barbell strategy is followed here by participating in companies which have huge exposure to the US market in the generic as well as specialty segment. While on the other hand, we have companies which have high share of profits coming from the domestic business. Continuing with our philosophy of focusing on sectors which have seen supply disruption, we have an overweight position in a telecom play, which is likely to survive in the current disruption, but have very strong balance sheet. Of late, we have also moved some of the real estate exposure to construction space, given construction has relatively less cyclicity. We have over the last 1 quarter increased exposure to the IT space, and it is now marginally overweight at around 13% as on July 2020. The sector has very strong cash flows, valuation is reasonable, free cash flow yield is high, and capital allocation policies are shareholder friendly. In terms of underweight, BFSI is a large underweight with around 25% exposure to the sector with a 4% underweight as on July 2020. The sector has strong linkage to the underlying macroeconomic theme, which is seeing pressure because of COVID. We have reduced our exposure or moved out of some of the exposure which have relatively weaker liability franchises. Impact of COVID on this sector will be back-ended because of the moratorium offered by RBI. Another sector where we are underweight is energy. However, within the energy space, we have overweight in gas as well as utilities. We think the growth runway of the gas transmission business is long, and city gas distribution is also expanding. Consumer is another sector where we are underweight, with around 10% exposure to the sector and a 4% underweight. This is largely driven by valuation consideration in the staple segment, where we think the implied growth rate is suggesting a double-digit kind of a growth, which is kind of pricing it to perfection. However, we are having exposure to the consumer discretionary names where we think margin profile is strong, cash flow profile is strong, and the growth runway is kind of large, and penetration levels are also low. Broadly, over the last 1 quarter, we have increased exposure to IT, construction, and consumer discretionary, while reduced exposure to BFSI, real estate, and utilities. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.